right, so what we're going to do now is break down your mortgage payment because this can be kind of confusing. So let's say your lender is giving you pre-approval. So he says, hey, you're pre-approved up to $200,000 and you have to put 3% down on a 30-year note at 3.5% interest rate. So 3% down, $6,000 on a $200,000 house. So these four things are basically the breakdown of what's going to go into your monthly mortgage payment. So these numbers here, for example, 200,000, 3% down, 30 years at 3.5% will be about a $1,300 a month mortgage payment. And so here's how we figure those out. So number one is your principal and interest. This is based on your 3% interest rate per year. So that's $871. That's a pretty fixed rate, or a pretty fixed number. Two and three, however, can actually vary quite a bit. And so this is how you can save money on your $1,300 a month and maybe figure that out a little bit better. Taxes on this, we're estimating at $208 a month, which is about a $2,600 a year tax bill. So depending on where you're buying, you might be able to factor those taxes and go, hey, we can save a couple $100s a month by living in a different location. Or if you go, hey, I want to be in a newer area or something, taxes may go up. So you have to keep that in mind, is that just because you're buying a $200,000 house, your taxes can vary quite a bit. So you have to know that number. One of the other things that you need to know about taxes is that there is something called special taxes on newer homes. So if the home's been built within the last 15 years, they typically come with specials, and this is all for the construction that's gone in, the plumbing, the utilities, everything that goes in to create that lot for the house so that the city utilities can be provided there. So sometimes on that, a new build for instance, you can see specials up at $25,000, $30,000, $35,000, $40,000. So that goes in, you got to pay that off over a 15-year period typically. So taxes are very important in this number. So this again is about a $2,600 a year estimate, which is pretty common. So insurance, we are estimating $133 a month, and that's about a $1,600 a year insurance bill, which is pretty good. So for a $200,000 house, that would be a good estimate. But you can shop around for your insurance, bundle them with car and auto. You can usually get a good deal. So check around with your insurance companies, because I've seen huge swings on this where you can save quite a bit of money in your monthly payment by finding the right insurance company. And then number four, your PMI or your MIP. This is basically your lender's mortgage insurance in case of default on the house. So PMI is for a conventional loan, MIP is on an FHA loan. We're going to estimate this at about $85 a month for a PMI in this example on a conventional loan. And so that basically lasts until you have about 20% of equity in the house. So as soon as you get to that 20% of equity in the house, this falls off of your monthly payment, which is really nice. So these four things go into making your mortgage payment. This is an example at $200,000 for the purchase price. So as you understand this and you can see the variations, the next thing that you'll be ready to do is go shopping for your house.